There are growing hopes of an economic stimulus package in the United States to counter the effects of the COVID-19 outbreak. The optimism follows the surprise decision of the Federal Reserve to cut interest rates. It's the first time the U.S. Central Bank has cut rates in between scheduled meetings since the 2008 financial crisis. Investors have interpreted the 0.5% cut as a sign of the Fed's panic. All three main indices on Wall Street closed almost 3% down. Asian markets also struggling for traction, starting the day in the red but ending mixed. Investors instead turning to safe haven assets, so that sent the 10-year Treasury yield to its lowest return below 1%. The historic plunge in the world's benchmark bond suggests more Fed rate cuts are coming. Some analysts are expecting another 0.5% reduction by mid-year, but they also warn that monetary easing isn't a perfect cure.
We do recognize that a rate cut will not reduce the rate of infection. It won't fix a broken supply chain. We get that. We don't think we have all the answers. But we do believe that our action will provide a meaningful boost to the economy.
Analysts expect the rate cut could set off a wave of cuts from central banks across Asia, with these regions showing those that have already taken action this year. So calls are growing for a more multilateral approach.
We're in active discussions with central banks around the world on an ongoing basis, as you would guess. I've been in regular contact with central bank leaders from around the world. That will continue. Central banks are doing what makes sense in their particular institutional contexts, but we're all talking to each other on an ongoing basis.
And for more, we're joined by Rajiv Biswas, Executive Director and Asia-Pacific Chief Economist at IHS Markit. Rajiv, did the Fed's move by cutting interest rates backfire, judging from how the markets reacted?
I think the Fed was obviously trying to be preemptive in the face of the escalating epidemic that's having more and more impact globally. So they did what they felt was necessary to try to support growth, given that global growth momentum is weakening and is likely to be affected significantly in the coming months. But obviously markets were spooked by the move coming in between meetings, and it was a signal, I think, to the markets that the outlook is probably more difficult than they perhaps anticipated for the U.S. economy, which at the moment is not really in the forefront of the economic shocks anyway, which are particularly hitting the Asia-Pacific region at the moment, China at the epicenter, and then many of the other Asian countries. But for the Fed to act between meetings, I think communicated to the market that the U.S. authorities are now very worried about the outlook also for growth at an international level and particularly in the U.S. as well.
So do you think then rates in the U.S. and elsewhere is going to head even lower?
It's likely that the Fed will continue to ease monetary policy. And I do think certainly in the Asia-Pacific, we've already seen many central banks easing. And given we've already seen quite a lot of economic shockwaves coming out of China to other countries in the Asia-Pacific region through tourism and weaker factory orders, we're going to see more easing also in the Asia-Pacific countries in the months ahead. I think certainly China will be doing more to try to support industry and pump more liquidity into the financial system, given that Chinese industry and small businesses are facing tremendous economic pressures right now due to the slowdown in business activity. South Korea is also facing now a similar challenge, I think, in the coming weeks ahead, where its consumers are probably also going to be becoming very cautious about spending, and that will hurt businesses in South Korea. With the numbers of cases also rising in some other countries globally, the concern now is that global growth momentum will also take a bigger hit than perhaps people had anticipated a month ago. So all of these things suggest that monetary authorities, the central banks are going to be doing a lot more in the coming months, not only in Asia, but also elsewhere in the world. However, of course, there's big challenges for the European Central Bank and the Bank of Japan, both those regions are facing economic challenges because growth is weak, but they've run out of policy space to do much more in terms of at least conventional policy, and even in terms of quantitative easing, their runway is very limited. So I think the more and more emphasis is going to shift to what fiscal policy adjustments can be made by governments. We've already seen the beginning of fiscal policy stimulus measures by a number of Asian governments. Today, South Korea announced a $10 billion stimulus package to support the economy. We've already seen Hong Kong SAR authorities also have put out a strong fiscal stimulus. Singapore, of course, a few weeks ago also had a stimulus package. And I think more and more Asian governments are going to be needing to do this to support growth as best they can. But it's a very difficult challenge because it's a health epidemic, so conventional policy tools will not be as effective as in a normal downturn.
Well, thank you very much for your analysis. Rajiv Biswas, Executive Director and Asia Pacific Chief Economist at IHS Markit.